Good afternoon and welcome to the Science and Sport PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to James Simpson, CFO, and Stephen Moon, CEO. Good afternoon to you both.
Good afternoon. Thanks, Alessandro. Good afternoon to everyone. I'm Stephen Moon, the Chief Executive of Science in Sport. I'm going to take around about 20 to 25 minutes to walk you through the 2021 final results, give you a flavour of how 2022 is going. We're just going to take a little bit of a diversion to talk about where we are on strategy. We're going through a major investment phase right now, so I just wanted to refresh everyone's memory and reiterate where we're going investment-wise. So let me turn the slides. The highlights for 2021, we had a very strong year. Obviously, like every other company, we were affected by COVID in 2020. In 2021, our major goal was to get back into growth. We returned to growth. 24% is a pretty familiar figure for us. So we've delivered the sort of 24-25% growth consistently over past years. So back to what we would call normal growth. That ended up in a 62.5 million revenue line, and we saw growth in every single channel, online and in retail, which was a positive. It shows that the world's finding a way to deal with the pandemic. Our gross margin, we were pleased to move it up 1 point. We saw some pretty strong headwinds on Brexit in the first half, and then in the final 4 months of the year, some input price pressure came to bear. We think we've got that handled. And again, I'll take you through that in a slide in a few minutes. We started our major 3-year investments in technology and in a new supply chain facility, and both of those are going well and on track. And then we delivered an EBITDA profit of 2.2 million, and cash in bank was 4.9 million. That was in line with management expectations, and took into account the heavy investments in phase 1 of the new factory. So 2021 was a solid year for us. We've obviously just closed Q1 of 2022. So to give you a flavour of that, to the end of February, revenue grew at 18%. That's in line with where we need to be, so we're quite pleased with that. And we closed our March month and Q1 last week. March was a record revenue month for the business, and again, strong performances across all channels. Difficult to pick one out. Very pleasing to see a very strong performance from UK retail. Gross margin was robust. We're dealing with historically high whey protein prices. Nevertheless, we're mitigating that with efficiencies in supply chain, in product mix, channel mix. So the gross margin is holding up well. We've got slightly ahead on our new Blackburn supply chain facility. We started shipping live orders out of the facility about halfway through March, and we expect to be fully operational on a logistics basis in the next 10 days or so. Gel manufacturing, we're putting in place the world's largest gel manufacturing in the sports nutrition sector. Factory testing is going okay for that, so we expect that to be off and running in July as planned. So a major capital project online. I just wanted to take a few moments, and James will assist me. I just wanted to loop back on where we're going strategically, and how our current capital investment phase is underpinning execution of that strategy. So to look at our proven strategy, so we've been operating for several years now. At the heart of the business is our science, our sports science team and facility, and our work with elite athletes. So that's underpinned science in sport throughout its whole history, and now science is increasingly underpinning the PhD brand. So at the centre of our growth flywheel, science and elites, we've got two premium brands which are in very good health. The next block we've put here data science. We had the term customer experience before, and we've invested quite heavily in this area now, and we're pretty clear that data science will give us great customer insight and customer experience. That flows into global online scale, which for us is our own e-commerce platform and Amazon. And then finally, efficient supply chain. So that's been our strategy for some years, and it's led us through a pretty consistent growth curve. In the enablers, the one I will pick out is our retail business. Retail is a substantial piece of business for us, and it's extremely profitable. In addition to the cash that throws off, it's a great vehicle for brand awareness and brand trial. So it's intrinsic to fueling the growth of the flywheel. We're in a pretty heavy investment phase now. Started last year, will finish in June of next year. And what we're trying to do here is two things. We've got a supply chain capacity blockage right now. We moved into the current factory when we did 5.4 million, and last year we did 62.5 million. So as you might guess, we're out of space, we're out of capacity, and that's dragging on costs. So lifting our supply chain capacity will remove the blockages, and it really underpins our ambition to move our gross margin to the mid-50s in the medium term. So that's investment objective number one. And then number two, to extend the reach of our online business. So how can we use technology to broaden our customer base through insight and efficiency? And how can we use insights on audiences to upweight our average selling price, conversion, and other key metrics? And that's going well, and I'll say a little bit more. At the end of this cycle, we expect to be a highly cash generative business. We've said repeatedly, and I've said it on one of these podcasts, medium term ambition, 100 million of revenue with a double-digit EBITDA and highly cash generative. James Simpson will take us through how we're funding that significant capital investment. To walk through those two blocks, and I'll not labour through these block by block, but if we look at supply chain, we currently fragmented over 4 sites. Our gel capacity is now completely out. So we are just commissioning a factory which will allow the business to grow to 200 million in its current format. And we're quadrupling our isotonic gel capacity. So that should remove our blockers. We'll start to see logistics savings flow this year, and around about £1 million per annum of savings. We'll commission a gel line in July. The line's costing us 2.8 million. Payback on that is extremely rapid. Savings will be around about 1.5 million this calendar, and next year 2.8 million. So it's an extremely rapid payback on that project. And then we currently run with one protein mixer splitting into 2 lines, and the new factory's got 2 complete protein lines. For 2023, we're looking to further continue our insourcing journey, and opportunities such as in-house biomanufacture at the top of our list. we believe that with the right investment, the right line, we can consolidate some of our quite complicated outsourcing of bars from around the world. And we see that opening up a substantial gross margin opportunity, but also giving us the capacity to explore new territories and new channels. So that will come to an end. That phase comes to an end in June, July 2023. And then it's all about optimizing that operation and driving on from there. So there is no substantial capital investment after the middle of 2023. We're all done and on the road to 200 million capacity wise. On technology, we did a lot of work last year on our own e-commerce platform, made it 30% quicker, more efficient. We installed a customer data platform in May, and by year end, revenue per visit to the site was up 8% from May to December. So that's worked and paid back extremely quickly. We're extending that technology this year, and we're putting in place some ancillary software investments. Overall, we're seeing the effects of that come through quite quickly now. Q1's average selling price was up 20% on the same quarter last year. We're up a couple of points on conversion. Average basket size is up. So we're starting to see more and more positive trading metrics on our e-commerce site. And we're also, with some of the other integrated software we've now implemented, we're starting to see a much higher return on investment for our digital marketing pound. So that's really we'll really transition on, and we're understanding a lot more about consumer. We move into predicting consumer trends, and we really believe that technology can significantly improve our growth in all channels. It's not purely a e-commerce play for us. So those are our two investment themes, and James will just walk you through the financials behind that in some detail.
Thank you, Stephen. This chart sets out the supply chain and technology strategic investment cycles that Stephen ran through on the previous slides. Just walking through, on the left, you can see 2019 and 2020 historic CapEx spent of just over a couple of million annually. The box highlights the 3-year strategic investment cycle that we're currently in the middle year of. The yellow bar at the top is capacity, mainly the new Blackburn single operating site in 2021 and 2022, and then investment in in-house manufacturing capacity in 2023. The blue bar in the middle is technology. As an online, science-led and data-enabled business, we see technology and developing a strong in-house team and investing in our core platforms and online trading as a key enabler of sales growth going forward. The darker grey bar at the bottom is innovation. That's driving our new product development, which made up nearly 4 million of sales in 2021. You'll notice in 2023 there's a slight increase. This is us building a world-class performance laboratory to enable future product development with the elite teams and athletes that we work with. As we step out of the 3-year cycle, you can see in 2024 that we return to a lower level of capital spend once those strategic pillars are in place, which we see as more representative of future CapEx investment. As we move to the next slide, what we've done here is basically set out for each of the different 3 years what our CapEx is. So the grey bar you'll see declining from 2022 to 2024 is the CapEx spend that we just ran through on the previous slide. And on the right-hand slide, this looks at how we're planning to fund this investment. Please note that this is not a forecast or a net debt summary, as it excludes the closing 4.9 million cash at bank at the end of 2021 and asset financing already in place. what you'll see moving from left to right is that the yellow free cash flow before capital investment increases. We've got an 8 million invoice financing credit facility, which was agreed back in 2020, which we plan to continue using throughout the 3 years. And what we're working on with HSBC at the moment is a structured loan, which should be approved by the end of the month. We see this as providing in total sufficient funding overall for this phase of our investments.
Thanks, James. I guess the only point to hammer home there is we've said consistently for a period now, we're not going to raise equity, and we're not going to raise equity. We feel we've got more than enough headroom to go through this investment phase, and you've got a business that's increasingly cash generative as we exit the other side of that. The only scenario where we would contemplate equity raise is if we went for an acquisition, and quality acquisitions in the performance nutrition sector globally are pretty rare. So it's unlikely, but not never. But we don't need any more equity to drive this business on to its full potential. Operationally, a very strong year for the winning science and winning product team. A third of the growth came from new products. PhD, probably the best example was PhD Diet Plant. In retail in the UK, PhD is now the #1 plant protein brand, and in fact, PhD sells more plant protein powder in retail than the next 5 brands put together. So, while it's not a huge amount of our business now, we've certainly adopted market leadership quickly. For Science in Sport, we launched our novel beta fuel, high carbohydrate technology. We've got some significant scientific support for that, and we're going to be leveraging that science and performance message hard as we market the products from Q2 onwards. And we've got 3 other substantial scientific research projects underway, which we believe will lead us to commercial success in the next 12 to 24 months. Winning Elite, we continue to be the business in the world that provides products to elite teams in a range of sports. We have put 330, it's actually 350 teams that buy product from us. We've got a proposition called Performance Solutions where teams pay us and we provide nutritionists and bespoke products. And we're just about to announce one of the leading Premiership football teams has entered into a 4-year agreement with us for Performance Solutions. We're also in discussion with a large American sports franchise right now, and we've got teams as far and as wide as Formula One interested in that service. So overall, our elite customer base and things like Performance Solutions give us a huge amount of insight to drive our innovation. Data science, I think I've mentioned this, so I've made all these points clearly. It's a big bet for us. We've invested and we've got a high return. We're going to invest this year and we're expecting another high return. So data science going well. In terms of brand awareness, PhD, we've owned PhD for 3 years, and it's gone from a middle of the pack brand in terms of awareness to we're now #3. We're just a smidgen behind Grenade in terms of awareness. We've got a highly effective awareness to usage cascade. In terms of quality, on 12 brand equity measures, we're #1 against 10 of them. So we're seen as a very high quality brand. So PhD is in good health, and we're investing harder in the brand this year. In Science in Sport, we're a clear #1 in endurance nutrition. The reason it says #2 there is because awareness of MyProtein bleeds over into endurance. But we're the undoubted leader in brand and in brand equity in endurance nutrition, and we lead in all 12 brand equity measures. So both brands are in good health, but we need to keep investing and we need to keep bringing great innovation to bear. Scale-wise, online sales in total, Amazon and .com, they were up 40%, and it's now 56% of the business. Our US business grew 50%. We've got a decent business starting to emerge for PhD in Japan. We're just setting up our business in India now. In fact, we've got some of our team members out there, and we've extended our already strongly growing Amazon platform into France, Poland, and Sweden. So the online business is going very strongly for us. If I break it down into digital, our own platforms grew at 28. And if you take a look at the table on the right and work your way down all the metrics, you can see that we made progress in everything except conversion. So selling price, basket size, orders, traffic. Some of these key metrics have become even stronger in Q1. So we've added 20% to our average selling price. For example, we've put 2 points on conversion. So so we're starting to accelerate through good use of technology. So our online business is in good health. Amazon business, again, table on the right, some very good metrics. And again, we're strong in Q1 of this year. So average selling price 2021 was £12.50. It's £14 for Q1 22, and Q1 traffic is up 34% on the same quarter last year. So our online business in very good health. In retail, we returned to decent growth in the UK. With the number one protein powder in UK retail and with the number two protein bar in grocery. I've already mentioned that we're number one in plant protein powders in the UK. And gross margins held up really well. In fact, we nudged ahead ever so slightly. International, we got some growth out of it. We exited a lot of our subscale businesses and started to focus on what we believe are medium to long-term scale markets. So we started to make good progress in Germany in retailers. Our Shimano business, which already blankets Europe, is now extended into Brazil and Colombia. So yeah, we're adopting a fewer, bigger, better approach to international retail, and it's started to make good progress after a severe battering from COVID. Supply chain, I think I've mentioned all of this. We're feeling okay about gross margin. It's a very turbulent world, but we think we can mitigate it. We're not looking to improve gross this year. We think if we can maintain gross flat, that will be a good result. So so we're in good shape there. And other than a picture of a very large shed, I think I've mentioned all these items. We're on track and ready to open the facility. James?
Thank you, Stephen. On ESG, environmental, social and governance, it's something we take really seriously within the business and see as a real competitive advantage. So during the year, we got real living wage accreditation. We also did our first carbon audit and became a carbon neutral accredited business. We've moved PhD protein containers to recyclable pouches, and we're looking to do the same for SIS in 2022 as well. There's a long list of social development partnerships we've got. The aim of these is to really facilitate access for young or disadvantaged sports people into sports. And these are not just in the UK or Europe, but in Africa and the US as well. We've got a diverse workforce which over-indexes both on nationalities and ethnicities compared to the UK average, which was supported in wellness and well-being during COVID and into 2021 as well. One of the things which we're working hard on at the moment is around our B Corp submission, looking to get accredited in 2024. The idea here is to really go for the highest standard of ESG. I'm told there's only other one listed business that's managed to achieve this in the UK. And so this would be really a leading achievement for us as we start to make progress on this. Moving on to the income statement. You'll have seen the income statement, which is lifted from the RNS. Stephen's already talked about the top line revenue, which grew 24%, and the 1% gross profit margin improvement from 49% to 50%. We've flagged the improvement in brand awareness and consideration, and you can see there the marketing spend which underlies that brand equity. Distribution costs included a one-off half-on Brexit impact and also reflect the impact of online international growth as well. We continue to manage administration costs tightly, and you can see our underlying EBITDA at the bottom doubled from 1.1 million in 2020 to 2.2 million in 2021. Looking at the brand split, we touched already on how the SIS brand has grown revenue 30%, and the PhD brand has grown 19% over the year. SIS gross margin remained strong at 61%, and PhD margin improved nearly 3%, up to 38%. SIS carriage costs were high from higher online sales mix, including US growth, which is a higher percentage carriage rate, and the half-one Brexit impact, which mainly impacted the SIS brand. PhD marketing spend increased at a faster rate as we invested in online growth. And then finally, moving on to the last finance slide of cash at bank, we touched already on where we are in the middle of our strategic investment cycle, and you can see that the main cash movement during the year was CapEx, predominantly for the Blackburn single site facility and also for the technology investment that Stephen ran through earlier on the roadmaps for both of those two strategic enablers.
So just to close out, the outlook as we see it, we think the year's on track. We're certainly pleased with the revenue and gross margin performance in Q1. We're going to continue to invest in premium brand, in technology and data science. The Blackburn single site is a major milestone in the history of the business and will really give us some scale and cost efficiencies. Capacity there to do 200 million of revenue per annum. So that's very exciting. We believe in our strategic growth model. We're using the same model which has worked well for us to date, and we've modified it slightly as we become more capable in areas such as data science. You can see from the slides James showed you that we're well into our second investment phase in growth drivers, and the third one being doing something about our fragmented bar supply. So we're still in a place where we're confident that 100 million of revenue in the medium term, double-digit EBITDA and highly cash generative is within our grasp. So all on track, really. We were pleased with last year, and we think 2022 is off to a good start. So thank you to everyone. I'm aware that Alessandro might have a few questions in the pipeline.
Yeah. Stephen, James, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right hand corner of your screen. But just while Stephen and James take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received 2 pre-submitted questions from investors, and I wanted to start off the Q&A session with these. The first one reads as follows. Subject of appointing joint brokers, could you confirm whether existing shareholders had asked you to consider the appointment of joint brokers, or was this an internal board-led initiative? Was the goal to improve liquidity, and has it worked?
Yeah, it was an internal decision. we felt that joint brokers could potentially improve liquidity. We were also quite keen to get a second broker out in the market, so that you had a couple of different perspectives on the business and the sector indeed. We went with Davy because they've got a broad exposure to European and US investors, but more importantly, they bring a wealth of knowledge about the sports nutrition sector to bear. They've got a very specialist knowledge. So internal decision, and it was about broadening awareness of our business and investor communities globally.
Stephen, thank you. That's great. The next question reads as follows. How has the rising cost of power impacted the business? Will you be passing on increases in manufacturing and transport costs to the consumer? If so, what will it do to the price of products to the consumer?
James, do you want to pick that one?
Thank you, Alessandro. So we're in the fortunate position of having secured both our gas and electricity rates over the medium term. So from that point of view, despite all the energy pressure, we're not immediately exposed to that. And on that point, won't be raising prices linked to the gas or electricity energy input costs.
Perfect. Thank you very much. That concludes the pre-submitted questions. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Stephen, James, could I just ask you to read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you from the end. Thank you very much.
So the first question we've got is from Matthew, and is: are any of the competitors moving into the premium end similar to the Active Lifestyle brand, and how big is this addressable market compared to protein powders? The market, I mean, the protein market in its own right is a huge market and continues to grow. Active Lifestyle, it's very hard to define because it could include a number of things from nootropics, meal replacements. So it's a huge space. We think that moving away from, we can't compete with players such as Bulk and MyProtein. We just, we can't compete with their scale in pure protein, and we wouldn't want to be honest. We've not really set our stall out to play a price game. So we're moving more and more towards premium margin products, and we're using our scientific capability to underpin some of the current and new products we're bringing to market. So are any other competitors moving there? Difficult to say, really. They probably would tell you they are. I'm not so sure. I think you're seeing products bleed from protein into Active Lifestyle, but also mainstream products bleeding into Active Lifestyle. So it's an area in the middle. We think it's a really nice fit for PhD, given its premium brand equity attributes. David has asked, could I share the analysis of the decline in awareness for the SAS brand from 30% to 26%? There's an odd anomaly, and I'm not sure if it's related to COVID or I'm not sure, or the reduction in events. But normally I would have been alarmed at this, but what we saw was every brand in endurance nutrition, awareness and usage marched down quite a bit. So we've gone down in line with the sector. It seems to be driven by external factors. All that said, we should get our awareness up. So we've got some new marketing initiatives this year. We're going to drive harder in a few areas. We're going to keep investing. I'd obviously like to see it higher than that, but we don't stand out from any other endurance brand in terms of the rate of decline. Mark has asked, has the business been affected by any supply chain issues? Nothing that's hurting us ongoing. We had trouble getting products into China last year, shortage of containers, etc. We've talked about whey price increases in Q4. We think we've got that handled. We've had some recent issues related to the conflict in Ukraine, but we've managed to mitigate that by opening up new suppliers. So we don't have anything that we really see as ongoing. Simon asks, we're well on the way to the ambition of 100 million. How much do you see this being driven by growth in the US? We would like to see 10% of the business at 100 million in the US. I think in the US, it looks like a huge market. The issue with the US is also the cost of internal logistics across the USA. So actually our growth in the USA is more modulated by logistics costs than it is by the growth not being available. All that being said, we'd like to double it fairly quickly from where we are. But we do see other international markets as being major. We can see 10% of the business as 100 being in China, for example. So we're not reliant on any one single international market. Your largest customer makes a strong contribution to revenue. Does that relationship remain strong? Yeah, I mean, just as a general comment, customer relationships in general have strengthened over COVID. It was a case of, with the disruption resulting from the pandemic, nobody knew the way forward. We found smarter, better ways to work with our big customers. Relationships are closer. Classic example would be with rising input prices. We were able to pass through a price increase through grocers and high street accounts. And if you'd have tried that 3 years ago, you'd have got your hands chopped off. So so customer relationships they remain strong. They're always robustly contested, but they remain strong. David, what are your price increase plans for the year on a like-for-like basis? We across the piece, we've got price increase away across all channels, and it's offset. It's offset our input prices at this point, and of course, no one on this earth knows what happens as this year progresses. But we currently handled price increases offset input increase. And then, of course, we've got more efficiencies, scale efficiencies, channel switch, product mix that are all favourable. So we feel in decent condition. And are your 2022 cost savings an opportunity to take share? Let's see, really. At the moment, we've got quite an ambitious growth plan for this year. We're hoping to see some savings, and we'll probably see how the world's set as we come into Q3. Obviously, for all sports nutrition businesses, Q4 is a huge quarter, so we'll probably take a breath in Q3 and see if we've got any more fuel to throw on the fire. And Gary has asked, you mentioned in your proven strategy slide the ambition to achieve 250 million and the previously disclosed maximum revenue capacity for Blackburn is 200. How do you plan to achieve this target, and will it require additional capex? In pure nuts and bolts terms, with pretty much non-material capex investment in that new site, we could raise the capacity to 250 million. The 250 million is our internal. It's really our internal. Let's look at a target in the distance and see how we can hit it. We had always said we wanted to get to 50 million by 2020, and we got there early. Then we said we wanted to get to 100 million. Fingers crossed, we'll get there a little bit early. After 100, we said let's raise our sights and go for 250. But It's an ambition. We've hit our ambitions in the past. The mechanics of capacity for it, yeah, we've got that covered in any case. Those are all the questions we've got in the bank here. If anyone's got any last second ones.
Stephen, thank you for that. I think you've addressed all those questions from investors, and of course the company will review all those questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Stephen, could I just ask you for a few closing comments?
Yeah, a few closing comments. Well, as always, thanks to everyone for showing up on the call today. I think we've got the highest number of investors and interested parties we've ever had on this call. So it's always gratifying to see the interest in our business. We think we've got a good story. We think we've got a proven growth model. We had a good year last year, and this year, if early indications are anything to go by, should be another good year. So thank you to all for attending the call, and I look forward to seeing you when we do our interim presentation later in the year.
Stephen, James, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Science in Sport PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.